On Sunday evening, March 12th for us, Signature Bank also failed and was taken over by regulators. Today, I'm with financial expert Kevin Matthews. Kevin, as I said, let's get right into it. And I guess my first question is, hey, what the hell is going on?
Yeah, man, it's unprecedented times for like the 15th year in a row, it feels like. But at the end of the day, we call this a classic bank run. It used to happen a whole lot in the 1920s and 30s. And it's basically when you have too many people asking for all of their money at once at a bank, and the bank doesn't always have that money on hand. The reason why they don't have it, though, is because they use that money to loan for mortgages, business loans, car loans. They also invest that money. So they almost never have the money right then and there. But when you get, millions and millions of people to say, hey, I need my money right now, that's what you run into. You have a bank run.
And you had viral post on Twitter is how we got here today. So I'll share this. I'll read it for the listening audience. Mm-hmm. I don't know why y'all aren't watching on YouTube at the Marcus Garrett, where we are universally branded. But Kevin said today, Silicon Valley, the nation's 16th largest bank, collapsed, and he has a rundown of what had happened. At the time, it had over 2,000 retweets. I'm sure I think it was like 2,500 the last time I looked at it. So you talked a little bit about there as far as the 1920s. The bank failed due to a classic bank run. Banks operate by taking a portion of the deposits, money from me and you, and loaning them to other people for mortgages, business loans. So what you're describing there, I guess these are normal business practices in these unprecedented times?
Yeah, these are absolutely normal practices. What the issue was here is that, this is Silicon Valley Bank, which means they primarily have tech customers, tech businesses, or businesses in the tech field as customers right now. Well, over the last year or so, which industry has been doing the most layoffs? Which industry has been struggling the most? It's been tech. So those are the companies that have had to withdraw those funds for various reasons. And it really kind of put a lot more pressure on the bank, more than what they expected. And they don't have other clientele that's not in the tech space, like a Bank of America or a JP Morgan does, where they're a lot more diverse.
For myself and senior millennials like me, we start thinking of Lehman Brothers, Goldman Sachs. Is that this again? What are we looking at here?
It feels like that, but on the base level as to how we got here and why we got here, it's not that. There are two reasons as to what happened in 2008. So as I mentioned in the thread, there are two ways that banks primarily collapse. Number one is you get a bank run, which is rare up until this week. But that's number one, is you get way too many people asking for their money. And then the other one is when the bank doesn't have people pay back those loans for various reasons. That is what happened in 2008. You had large scale, failure in terms of people not being able to pay their mortgages, not being able to pay their car loans. And that is why the entire economy collapsed back at that point in time. And at that point in time, we had what was called contagion, which meant that it started with one or two banks, and then it spread out to just the financial sector as a whole, and then it spread out to the entire economy. Right now, this just seems to be a handful of banks, and it doesn't really seem to be that large scale, at least not at this point in time.
So for those who are not seeing it on the screen, you describe situation A, which we're talking about a bank run. Situation B is what the senior millennials like myself with our PTSD are living through, and that was the Great Recession. And the question that you actually posed and then answered is, why are so many people asking for their deposits back?
Yeah, so that goes back to who the clientele is. So we got to remember, when you go all the way back, it feels like 15 years ago now, but it's only, 3 from the pandemic. So when you remember when the pandemic hit and a lot of these tech stocks were popping, you left and right, Zoom was up 700%, Tesla was up. All of these tech companies were flush with cash because of what we call the stay-at-home play. Again, like Zoom, Slack, Salesforce, any tech company you could throw a rock at was doing incredibly well during that time. So those tech companies had a whole lot of money in 2020 and in 2021. Then the Fed started raising interest rates, and then things got real. And then you started to notice Peloton almost went bankrupt, right? Zoom has been down 80 or 90%, and a lot of those tech companies are struggling. So when they were doing well, they put their money in the bank, stuff was fine. Silicon Valley Bank said, hey, they're not going to touch this money. They're not going to need it. I'm going to loan it out to people. I'm going to make some money off of their money. Well, once things started to get rough and all of these companies started to withdraw their money, Roku being one of those that hasn't a stock that hasn't done well, once they started withdrawing their money a lot more often, that is when things got hectic for the bank, and it became too tenuous for them to kind of balance the investments versus the savings and deposit side of things.
Feel free to run through your resume, but like, what are you looking for next? Either what are your concerns, what are your pros, what are you looking for out there in the financial atmosphere, if you will?
Yeah, this is a good question. So for those that may not know, my background is in finance and economics. I got my econ degree at Hampton. I have a master's in business from UT Austin. Shout out to the 512. And I've been doing finance for almost 13 years. It'll be 13 years later in September. In terms of what I'm looking for right now, I'm just sitting back and watching, because it's hard to call. It is always very difficult to see where these things are going to go. But two, I think the most important thing is the whole FDIC insurance thing. If you have been to any bank, or you can check out your banking app right now, scroll all the way to the bottom of the app, I guarantee you're going to see a little FDIC sticker, or at least a logo. That is the Federal Deposit Insurance Corporation. They ensure that you are going to get every dollar from your bank, assuming it is up to $250,000. And people who had their money at Silicon Valley Bank, they were able to access their money today, so 48 hours later. So this to me is not a 2008, not a time to panic. I'm just sitting back and say, hey, this is one of the other things I can add to my millennial list of trauma from things we have seen since 2008 and beyond.
I'm going to end on a happy note, but I got to ask this question too. So, the popular meme right now, at least for a senior millennial like myself, I'm not sure what these TikTok dancers are doing, is a red flag. So what would be a red flag? Like if we did wake up on another day, you'd be like, oh, raise your eyebrows a little bit. What would be a red flag that we should be watching out for?
Yeah, so a red flag is any major national bank going under. That is something that would really raise an eyebrow for me. It's one thing, like, ain't nobody heard of Silicon Valley Bank, if we're being honest. Like, does anybody know the 16th, 17th, 18th largest bank? That answer is no. But I would be very concerned if this starts to be Wells Fargo, JP Morgan, Bank of America. And that's because these are much larger consumer bases, and that's going to tell us a lot more about the economy as a whole. And again, the clientele is going to be a lot different. You're going to have some tech, you have some regular people like us, you're going to have oil and all types of different businesses in there. But right now, again, this has all been a tech issue, right? Tech layoffs primarily, tech stocks crashing primarily. Everything else has been okay to find. And until I start to see that come across the board and more sectors starting to fail, then that's going to raise a red flag for me.
Actually, you dropped this in February 2021, so I'm gonna get your credit out there, man, because I like when people predict correctly. So do you still feel that way? Crypto investors genius are insane.
Yeah, I mean, so there's a legitimate case for crypto, and that's fine. But when it comes to these joke coins or these meme coins that people just hop on just for the sake of hopping on because a billionaire said it, you got to be careful about that stuff. Like Elon Musk got up on SNL and admitted that it was trash, right? So
yeah, didn't it drop like 20% the next day?
Right, and it's been falling ever since that day, and has not really recovered since. But you have people who weren't billionaires that didn't necessarily have all the basics of investing covered that were jumping into it. So hey, look, I haven't paid my student loans. Let me put $5,000-$6,000 in this thing and hope it does something, right? Some people got lucky. People who were in very early, they got lucky, they got out. But the majority of people, once it starts to become, local news, when you start seeing a local news segment, it's probably too late, right? So that's what people did, and they lost, and now they're sitting around holding the bag, trying to figure out when the next wave is going to come. And it may not, but you got to be real careful about that stuff. And for me, it's always interesting when you see people jump into stuff like that, but don't jump into like the basics. So I'll never forget, I had a barber in New York City, and I guess I shouldn't throw his name out there, but he was investing in Bitcoin. It's like 2017 when it first shot up and then immediately crashed, like right after that, right? Yep. And he was like, yeah, I've never done anything like this. I'm in this Bitcoin thing. You in the Bitcoin? I'm like, you realize I'm a financial advisor. I work up the street. Like, I'm like, you can do some, right? You can do some, but like, have you ever thought about investing in like, I don't know, McDonald's or Target? He's like, no, man, it's too risky. I'm like, what? I'm like, how is Bitcoin not risky,
Right.
but or how is McDonald's and like stuff you know and understand? How's the stock market too risky, but like Bitcoin not? And it's just like you got to make sure that your risk, your like how you react to risk and how you react to losing matches your type, your invested type. So if you ain't scared, fine, right? But if you want to be cautious and you want to be successful and consistent, those two things do go together. Then you got to spread your wealth out and be very measured about what you decide to do.
And I think you're going to say the same thing, but I see I have to hit some of these whenever a financial planner comes on, our advisor, because I get yelled out in my community if I don't. So we also need to talk about, unfortunately, meme stocks. Genius are insane. Your quote here is invest more into, I don't know which company this says. It's MSFT. And then you say, or them say, what do you think about AMC? And you say, y'all leave me alone about AMC. So what do you think about meme stock? Genius are insane.
Yeah. So MSFT is Microsoft. That's a ticker symbol. So you type in MSFT to almost anything, and usually Microsoft will come up.
Okay.
AMC, for those, we all know AMC theaters, right? But I'm not a fan of meme stocks. Not because they just, I don't know how to really describe it. Because now I'm getting mad.
I know the feeling.
Right. So no, I'm not a fan of meme stocks, and primarily it's because it suckers people into backwards thinking about something. So usually a company rises in value because there's something the company deserves to go up, right? For example, think of an airline. Pandemic is phasing out. Hopefully more people are traveling. The stock goes up. It deserves to go up. Makes sense, right? That's logical. Yes, more people shopping at Target, the price of Target stock goes up. That's logical, right? But in meme stocks and meme investments, it's backwards, where the stock starts to shoot up for no real apparent reason, and people just doing it and just jumping into it because it's a game, and you start to make up reasons behind the fact as to why it's going up, but it doesn't make sense. So like at the time, AMC had been falling for years. Like people had stopped going to the movies as much. And I will tell you right now, you're going to see stuff like Black Widow and a few other big holiday movies and stuff. But people are not ever going to go to the theaters at the same rate as they used to. That will never happen again, period. Why? Because I got Disney Plus. Why would I want to go step on sticky floors and pay $50 popcorn when I can watch in the comfort of my house as many times as I want for one price? You may not ever catch me until the next Avengers. You're not gonna catch me in the theater. Yep. So you're always gonna lose, whether it's 10% of people, 5%, whatever it is. You're not gonna ever see that. However, the stock was up like 1,000%. That don't make sense. Right? GameStop. People aren't going into buying physical games anymore. The new PlayStation, the new Xbox, they have digital editions where you never go in and trade in a disc anymore. It does not make sense for GameStop to take off in price because they don't make the games. You can't trade in a digital game. What are you here for? Like, it's the next Blockbuster, because that's exactly what happened to Blockbuster. Right. So meme stocks is backwards. So people are making up reasons as to why it should go up, and then they have to sit here and convince you to invest in it, which is weird. Nobody ever came to me and said, "Hey, you should really invest in Apple. Like, you should put all your money in Apple." Nobody ever told me that. But when it comes to AMC, they come after you and they will like force you and bully you and tell you why you should invest in something that when you really take a look at it, it don't make no sense.
The one that I want to transition to is generational wealth for the kids. And so you have a tweet here. This was from October 19, actually. My son had enough money in his account to get a share of Apple. He's got a total of 6 stocks, which actually I think has grown since then. Right now, only at 18 months old, this is what generational wealth looks like. Talk a little bit about that, what you're doing for your son, and why you're doing so.
Yeah, so I'll start with why I'm doing it. So it was 2010, long ago. It was a decade and some change now. So decades ago, I had an internship in New York. So it was my first time going to New York. I lived up there for 3 months for this internship, which is interesting because I ended up living in New York for like years later, which I never thought was going to happen. But aside from that, had a Wall Street internship. And when I tell you I was the worst intern in the world, I was terrible. But it was not all my fault. They didn't like really explain why I was there, what the stock market was, and like what are you doing? Why is this important? It wasn't until like the second to last day, and they had this this like website and tool we could use that told you, like, if you had invested X amount, you get to have this, or you would have had this much money. So being curious and a bored intern, I found out that my parents had only invested about $83 a month from the time I was born to the time I did that in 2010, that I would have had $810,000. $810,000 is the amount I could have had if my parents had only invested about $83 a month in Apple, and that was it. And at that point, I was shook. I'm like, wait a minute, this is what investing is? Why haven't you told me about this? What happened? Like, what do I do now with this information? And at that point, I wanted to make sure that my kids never had to ask that question: is what if? What if dad had went back in time and invested in this thing? How differently would my life have been had I had that type of money at this age? And that's what inspired me. I said, whenever I have kids, which at that point I was like, this will never happen, right? But whenever I have kids, I wanted to make sure they didn't have to have those types of questions or ever have that type of moment. So for both my son and my daughter, he's 3 now. She'll be a year next month. Both have investment accounts, both invest in Apple as well as other things. Because I don't want them to ever have to have that moment. And thankfully now there's so many more apps and options and opportunities that exist today that didn't exist then. Like, I don't even think my parents could have invested in Apple based on the way the stock market was back then. Like, you had to have an advisor. There were no apps back then. You had to like call some shady guy on the phone to make that happen. So I'm really glad that the world has changed since then. There aren't, those fees and stuff they would have had to pay. So I had the opportunity to do it, and I just wanted to make sure that I was able to do that for my kids, so I have way more options when they're my age.
Two funny things that jumped out there is, I'm at that, and I'm trying to resist it, man. I'm at that back in my day stage because I paid off $30,000 in debt with an Excel spreadsheet. That's all it was. I went to bankrate.com. I printed out a PDF, printed. I think I had to go to Kinko's, you know what I'm saying? And I put together my own Excel spreadsheet. So the kids are like, I don't know, I can't figure it out. I'm like, get it out. I'm sorry, I got a little animated there. I feel some type of way about it. And then the other was, I never knew. So I went to school at 19, I think I was, graduated at 22. I never knew how much my parents made, ever. It was just not a topic of discussion. Our money is our money. Don't worry about that. Get out my face. I was like, and they always made it seem like we was broke. And it was weird. I didn't realize, we were like, doing well. We were like, I guess, middle class, maybe upper to middle class towards the end, by the time I'm going to college, I should say. And I should have known, because every time I date, girls would be like, where are we going? We're going to the other side of town? They're like, where are you taking me? I'm like, I'm going home, right? The burbs, Like, I grew up in the gritty streets of the burbs. And so I finally had to fill out the FAFSA. And to your point, they didn't know how to do it. This is the only reason I found out. And I had to figure out, I was like, hey, I need your pay stubs. And when I saw how much my parents made, like, it was a fight. I was like, all my life I had to fight and grind. Y'all didn't get me that car when I was 16. Like,
you were asking me for McDonald's money. You had it.
I got my first job at 16, man. I remember I was so mad because they were like, if you want a car, you can get your own job. Now I went out 15 and a half. I had my resume filled out. I was like, I'm getting my money. I'm getting this car. So anyway, like, I know the struggle. The struggle is real. And I feel it even more in my old geriatric millennial bones. I had to get that out there. I'm sorry. These kids don't know how easy they got it. But to your point, let me plug this. You have got, and you plug yourself. We're at the wrap. So if there's any courses, there's a few. I've got one published to the chat for those of you who are watching live. And then I'll screen share for the people at home. You got a newsletter, but I'll let you know if you haven't hit everything, but the people at home will be able to see.
Yeah, so you can find me at all things social media at Building Bread. You can really find me a lot on YouTube and a platform called Public. It's an app for investors, so you can find me there too. If you go to the website, you'll see all my courses and information. I do want to tell y'all about the Investors Toolkit 2.0. It is my most fun class because I take people who have never invested before or have very little experience and take them through my entire investing process. And I think that's the big thing. Like, a lot of financial podcasts and investing courses talk about having goals, right? Goals are cool, but processes are better. And how do you get to that goal is the most important thing. When you focus on the process, the profit comes easily. So I'll walk you through my 7-step investing process, the process I used for my millionaire clients and obviously my most successful students as well. So I would encourage you to check it out. We do monthly investing calls for our students as well. So it's an added level of support.
And that website is buildingbread.com, correct?
Yes, that's correct.
And they can follow you at Building Bread on Facebook, Twitter, and Instagram. I believe, let me stop sharing this offer for the people in the chat. I believe we're at the wrap. Kevin, thank you for coming on the show. Always a great time, and I hope you'll come back and join us again.
Yeah, thank you for having me.